Have you ever wished that you worked for a company that provided you with a pension? Well, if you've been thinking that, there is another way. You could actually create your own private pension that's going to generate income for the rest of you or your spouse's life. Now, we talk about this today in Annuities Part 5.
Yeah, we have been working on this idea now for literally 5 different episodes as of today as to how can we utilize annuities? Should we ever utilize an annuity? What are the benefits? And just like Mer said, today we're going to answer one of those questions and help you to realize how you can provide a lifetime income that you cannot outlive. I will tell you that in our helping people get close that are close to or already in retirement, this is a very big topic. So we're excited to share it with you today. By the way, we always encourage you, if you don't mind, especially on iTunes, give us a 5-star rating and a written review. It certainly does help us. But for today, we want you to enjoy our episode, Annuities Part 5. Well, we welcome you to our Wednesday Retirement in Action podcast. And today we are going to continue to tackle this idea of how do annuities work? What are their different elements of what they do? And we have a whole new one that we're bringing on today with our Annuities Part 5. But before we do, I need to have Merce help us with our disclosure.
That's right. So I hope you're enjoying the podcast. In order for us to continue doing these, we just have to make sure you know a few things. One of which is that the information contained in this podcast is intended to provide general information only and not to be considered individualized advice. There are different types of investments that do carry different types of risk. As always, please contact your financial professional for advice appropriate to your specific situation. So with that said, I say we dive right in. There's been a few of these episodes, so if you haven't listened to any of the annuity parts just yet, I would encourage you to go back and listen to them to get a good idea as to what we're talking about. But I would like to do a quick recap before we head into what the theme of this episode is, which is guaranteed income. But before we do that, just so we understand where we're coming from, I want to let you know that what we're talking about here in the world of annuities, the major focus that we have in this series is on the deferred annuity arena. And within the deferred annuity arena, there's really 2 types of annuities that we can work within. We have the fixed arena, and then we have the variable side. On the variable annuity side, it is tax deferred. You can invest in the market. So what you're doing within that vehicle is you're buying mutual funds. Anytime you're buying mutual funds, there is risk. It can go up or down. And so one of the negatives, if you will call it, is you can lose money in these products. And then also something you may hear about is that the fees involved in variable products are rather high. So in order to make a decent return in these, you have to overcome the fees and then some. So for that reason, we like to stay in the world of the fixed annuity. And so when we're talking about the fixed annuity, there's really 2 types. You've got the traditional and you've got the indexed. The traditional is very much like a CD. So you go to a bank, you say, I've got $100,000. What is the guaranteed rate that you can give me over 3 years? And the bank's going to give you a rate of return. The fixed index or the fixed annuity, the traditional side, is very similar, much like a CD. You give the insurance company rather than a bank a $100,000, for example, and they're going to give you what the fixed rate is at the time. And it could be for a couple years, 3, 4, 5, up to 10 years. Within the fixed arena, principal is guaranteed. And also, so you don't have to worry about losing like you could lose in the variable side. So you're not really investing in the stock market directly. But what we've been focusing on over this series has been the indexed, so the fixed index annuity. And in this world, still tax deferred, but your return is based off of being linked to an index like the S&P 500, like the Dow or the NASDAQ, and several others that are out there. Once again, this one as well is principal guaranteed. So we've gone over some examples where, let's say the market falls, the S&P or the NASDAQ in a given period falls 10, 15, 30, 40, 50%. Well, you're not exposed to that. The worst you can do is earn a 0. So that's the quick high level of what we have been talking about, the fixed index annuity arena. Just a quick recap as well on how interest is earned. What we've discussed really is two types of crediting methods. Now, the crediting methods, they all revolve around this thing called an annual reset or a point-to-point methodology. And what that means really is, let's say you go into the annuity January 1, 2020. And let's say we're on a 1-year point-to-point period or an annual reset. So whatever the index does from January 1, 2020 to January 1, 2021 is how your interest is going to be calculated. Now, the calculation comes down to what type of strategy you are in. We've talked about in the previous episodes, we've talked about a cap strategy where it's a limit as to how much you can earn. So for example, a cap could be set at 5%. So that means if you're tied to an index and let's say the index returns 7% and your cap is at 5%, you're going to earn that 5%. So you have $100,000 in the annuity. It's going to be $105,000 at the end of that reset period. The other strategy is a participation. So you can participate as a percentage of what the index returns. So let's say the index returns, for easy math, 10%. And let's say your participation for that period is 50%. Well, you're going to earn half of what the index earns. So you're going to earn 5% there. So once again, your 100,000 becomes 105,000. So just a couple little things to catch you up to speed if you haven't already heard the previous episodes. But really our focus today on this episode is to talk about one of the reasons why we think that a fixed index annuity could be beneficial to someone's portfolio. Now, we always talk about the reasons why. There's three major reasons. The three major reasons that we believe are true or that somebody would look at a fixed index annuity is, the first one is just pure, safe, good accumulation with no downside risk. So kind of like a bond alternative, you're going to make a bond-like type of return, but there's no risk. Even in this world, bonds are supposed to be safe, but they still have downside risk to them. In the fixed index annuity arena, we can take away that risk and still make a decent rate of return. So that's number one. Number two is guaranteed income. So in all essence, when we say guaranteed income, it's kind of like creating a pension or kind of like the Social Security that you may be receiving already. So something that you can count on that's going to be there. It's going to be a monthly pay-in for the rest of your life. And then the third reason is death benefit. We rarely use a fixed index annuity for death benefit, but it's out there. So, and we believe it is a good reason if it does fit. But once again, today, our major focus is on guaranteed income and how a fixed index annuity can provide that for you. So I'm going to hand it over to Raiden, and he's going to break it down for us very clearly on how an annuity can provide guaranteed income for us.
So want to talk about is how do we get guaranteed income? And the reason why that's so important is, when it comes into retirement planning, Merce and I believe that you really need to have what is called your essential income needs to be guaranteed. You want to have a guaranteed income stream coming into the house to take care of those essential needs. So we break income for what you need broken down, or what you want rather, or total income in retirement into three categories. One is essential needs. That means you got to pay the light bill. You got to pay the water bill. You got to maintain certain things that have to be done. The next layer of income is wants. And then the next layer of income is kind of what we call giveaway money, meaning I'm okay to give it away to the kids or to a charity or whatever it might be. But that first layer, essential income needs, Merce and I strongly believe that should be guaranteed. Now, what are our guaranteed income sources? One is Social Security. The other could be a pension. And then if outside of that, our avenue to get guarantees are limited. So an annuity with an income rider or an income benefit can give us that guarantee. But now we have to understand how it works. So when we add an income feature to an annuity that's going to give us lifetime income, but yet still give us access to the actual principal, we have to understand how it works. So we need to understand, first and foremost, why would we do it? Well, we're going to do it because we want to take care of essential income needs. Number two, there could be a fee. There can be a fee in a couple of different ways. One, a very clear-cut fee. It's 1% to have this rider. The other could be is you say, oh, it doesn't have a fee, but the reality is the fee is built in and you have what in all essence is a reduction in return. So the fee is still there. And I think you need to understand those different ones and then how they work, because an income rider that can give us lifetime income is a very powerful tool, but we just want to understand it. So in most scenarios that Merce and I ever make recommendations, if we're really trying to get the highest guaranteed income, we're going to have a fee. But that fee usually is going to be around 1%. Now, I want you to visualize in your mind that you've got this bucket of money, and let's just use some round numbers. Let's say I got $100,000, and there's really two things that are happening. So you got this bucket of money, it's in the middle, and on one side, you've got accumulation, how much it's actually accumulating for death benefit, and then on the other side, you've got this amount of income that it will generate. So the nice part is on these income riders, they give very good accumulation values or let's say mathematical calculations for what's going to provide you income. It's just very important that you understand that this is not lump sum money. This is income generation. So if you ever talk to an annuity agent, a life insurance agent who sells annuities, and that's what they do, and they tell you, hey, guess what? I've got an annuity right now that will guarantee you 6 or 7% growth. Be aware that that is not lump sum money. That is for income purposes. And I think that that's not really clear if somebody tells you it that way, but many will market it that way, at least verbally, and say, oh, I've got an annuity that will guarantee you 6 or 7% growth. And the reality is that is only for income purposes. Now, is that good? Yes, but we don't need to make it something that it's not. So just imagine that for a second. If I had $100,000 that I put into a fixed index annuity with an income benefit, and I told you that the income benefit is going to grow at 7%, roughly in about 10 years, my $100,000 is going to be worth $200,000. But remember that $200,000, I cannot take it lump sum and walk away with it. The $200,000 is really a calculator to tell me how much income. But now if I told you that the income on that is 6% of $200,000, that now is $12,000 a year or $1,000 a month, 100% guaranteed for the rest of my life. That's a pretty good deal. It's a really good situation. And so when we're talking about essential income needs, that's how we do it. So if we said to you, let's say that a person came to us and said, I need $4,000 a month guaranteed for the rest of my life in order to take care of my income or my essential income needs. And let's say that they've got, let's just go with Social Security is going to give them $3,000 a month and they're short $1,000. And we know that they're going to retire in a few years. We can do the calculation and say, in order to guarantee us $1,000 a month from a fixed index annuity with an income rider, we can tell you and calculate exactly what needs to go into the annuity to guarantee the $1,000 a month for the rest of your life. So we create, in all essence, a pension that you cannot outlive. It lasts even if the account value in the annuity went to zero, you will continue to receive payments based on your life. Now, you might ask, well, wait a minute, what if I'm married and I want to make sure income lasts not only my life, but my life and my spouse's life? That is doable. Just like any other thing, though, if I want to have it based on 2 lives, my income will be a little bit lower. Just like if I had a pension and I wanted survivorship, my income would be a little bit lower, but it would then be guaranteed on 2 people's lives. Now, the cool part is, the nice part is that most annuities with these income benefits do not make me make the choice as to whether or not it's going to be dual life or single life until I actually start taking the income. So I've got time to know what's going to happen, because many things can happen. If I'm in a scenario where I say I want to put money to work and then in 10 years I'm going to take a lifetime income, in 10 years from now, many things could change and I may not want to take dual income. I do not have to make that decision today. I make it in 10 years if I'm waiting 10 years in order to take it. Now, just so you know, I don't have to wait 10 years in most cases. I could just wait a year and start taking income. But just like a Social Security benefit, the longer I wait, the higher the income will be. So keep that in mind. It's much like a pension, much like a Social Security benefit. The longer I wait, the higher the income will be. Now, there's always a sweet spot there. And we have said this really on all of our podcasts around the annuity, because we are really giving you a lot of numbers and a lot of things that we're having to help you to visualize that can be very difficult to do just listening to a podcast and hearing words. And we know that. So if you'd like to see this and be able to actually see your specific numbers, we are providing the way for you to do that. And the best way to set this up is to go to our website, which is POM, as in peace of mind. So pomwealth.net. And on that homepage, right there at the top right-hand corner, you're going to see a button that says you would like to schedule a 15-minute phone consultation. When you click on that button, a calendar is going to come up and you'll see our calendar, and you can set a phone call with Mercer I, and we will walk you through and kind of give you a little bit more information for your specific situation. There's no obligation in this phone call. We're not trying to sell anything. We're just trying to say, hey, if you said, hey, I want to know, I'm 60 years old, I got $100,000. If I put it into an annuity right now, what would it look like in 10 years? We can give you those very specific numbers. So if you'd like to do that, take part in that, that's great. We're not going to try to say, oh my goodness, let's get you in here and start talking about how to sell an annuity. That's not our purpose. Our purpose is, I can't give you all this stuff on a podcast. So I'm willing to say, hey, we'll spend 15 minutes with you on a phone conversation and show you what your numbers could look like, just so you know, just so you can put it in your back pocket and understand, hey, this is something that I could potentially do. So if you want to do that, go to our website and we'll help you out that way. But we know that this is a lot. We are trying to take it step by step, like a little piece here, a little piece there. And that's why we've ran this series for as many times as we have, just trying to add on little pieces as we go. We don't have much more to go on the annuity conversation, but we're as things come up and we try to think, hey, how can we enhance our understanding of annuities and how does that work? We'll be glad to continue this process. But for today, thank you very much for listening to our podcast. We hope you have a great day, and we'll talk to you next week.